Chapter 31. Moving Averages and MACD. Moving averages appear on your charts as smooth lines averaging historical prices. These lines act as natural key historical support and resistance levels, and their strengths depend on the underlying time period measures. To calculate a simple moving average, use the formula sum of all closing prices for the previous time intervals divided by the number of time periods averaged. Therefore, for cheap stocks, 5-day moving average, you could find the current average by calculating 12 plus 13 plus 12.5 plus 11 plus 13.5, which are the closing prices, divided by 5 days, equals the moving average $12.40. The periods measured by a moving average depend on your charts. If you use daily candlesticks, then the moving average is calculated with the last 5 days in this example, whereas hourly candlesticks calculate the 5-hour moving average with 5. Moving averages are moving because they drop the last point from a series and add a new one once available. Therefore, to continue our example, we would drop the oldest $12 price from the 5-period moving average and replace it with the next period's price. The three most used moving averages are the 50, 100, and 200 moving averages. Since these are popular, many other investors will look at these price levels and consider them as support and resistance levels just like you. Because these levels are mostly psychological, these averages serve as support and resistance levels throughout all time frames. With that said, longer measurement intervals produce stronger moving averages. Here's a weekly candlestick chart of Tesla Inc. with all three major moving averages. From highest to lowest price in the beginning of 2018, we see the 50 moving average, the 100 moving average, and the 200 moving average. And the 200 moving average is the one on the bottom. That's the one where the Tesla stock would crash. It would bounce off there, crash again, and bounce off there, 2017, 2016, and then now it's been bouncing off there a lot more frequently in 2018. The most volatile moving average, MA, is the 50 MA. The intermediate moving average is the 100 MA, and the stable, lower moving average is the 200 MA. All of these averages use weekly values. We can make our moving averages less volatile with monthly candlesticks, or we can use daily or hourly candlesticks to make our graphs more volatile. Depending on the underlying stock, different time periods may make more sense. You can find past periods to analyze by searching for a moving average that acts as a valid support and resistance levels. In Tesla, we see that the weekly 200 MA in particular historically acts as a very strong support level. The stock tested this moving average support level 4 times in early 2016, late 2016, early 2018, and late 2018. However, the market brought extreme buying power to the stock at these averages, quickly reversing price movement. These averages can often be a great place to enter an order because you can expect the stock to move quickly away from the historically strong moving average level. In case the stock breaks through the MA in a downtrend, you can set your stop loss at a reasonable distance below or above the moving average if shorting. Add 50, 100, and 200 moving averages to all of your charts to analyze unseen support and resistance levels. Here's one more example with eBay Inc. From highest to lowest final price, we see the 50 simple moving average, 100 simple moving average, and 200 simple moving average. Then we can see historically the prices bounced off of the 200 moving average a lot, and there were some nice moving average crossovers, which we'll talk about very soon. In recent bullish years, eBay consistently bounced off its 50-week, 100-week, and 200-week moving averages to continue upwards, highest to lowest average lines respectively. The current price below the 200-week moving average suggests bearish sentiment as the stock enters a seemingly flag-shaped pattern with newfound lows past the supposedly supportive 200 monthly moving average. However, as we look toward eBay's pre-2008 crash price action, we see a significant moving average indicator, the death cross. Death crosses occur when a short-term moving average, say the 50 period, crosses a long-term moving average, 200 period. Death crosses indicate a significant shift in market sentiment. Crosses in longer-term movements averages, such as weekly or monthly moving averages, are significantly stronger than short-period moving averages. Weekly moving averages death cross is for a run almost every major market crash in the S&P 500. These long-term moving averages can predict a stock's price reversal for years, whereas shorter daily or hourly moving average death crosses can predict temporary price movement. Alongside death crosses, which suggest lower future prices, a golden cross forecasts higher future prices. This cross happens when a 50-period moving average rises above the 200-period moving average. After eBay's 2007 death cross and subsequent downtrend, stock began a recovery run-up and performed a golden cross in 2011. After the cross, the stock continued an upward rally. Often, upward trends indicated by a golden cross can last much longer than the downtrend indicated by a death cross. Simple moving averages form great setups on your charts. Some alterations of moving averages are weighted moving averages, exponential moving averages, and moving average envelopes. Weighted moving averages give more weight to recent prices. In our 5-day MA from before, we could use the following calculation: 12 times 1 divided by 15 plus 13 times 2 divided by 15 plus 12.5 times 3 divided by 15 plus 11 times 4 divided by 15 plus 13.5 times 5 over 15 equals 1247. Weightings can differ depending on how much you want to emphasize recent price trends. You can use any weighting metric you want as long as all the price percentages add up to 1 or 100%. In our example above, the most recent price is 5 times more influential to the moving average than the first closing price in the 5-day average. This is a normal price weighting since each time period closer to the current price is weighted one increment more than the last. Similar to simple moving averages, a new time period's price will enter this calculation as the most weighted factor, while the last price in the old average is forced out of the calculation as all other prices move back one weighting spot. Exponential moving averages, EMA, uniquely use previous exponential moving averages rather than prices to calculate new averages. To find an exponential moving average, use the formula current EMA equals constant times current price plus 1 minus constant times previous exponential moving average, where constant is 2 over the number of time periods averaged plus 1, and the previous period's EMA is the simple moving average for the initial EMA calculation only. Therefore, in our 5-day average from before, the EMA would be 2 divided by 5 plus 1 times 13.5 plus 1 minus 2 over 5 plus 1 times 12 plus 13 plus 12.5 plus 11 plus 13.5 divided by 5 equals 12.77. To recap, our simple moving average is $12.40, our weighted moving average is $12.47, and our exponential moving average is $12.77. Both weighted and exponential moving averages follow stock trends slightly faster than simple moving averages. You may find these averages more helpful in short-term scenarios where you want to quickly follow the underlying momentum, support, and resistance in a movement. However, short-term simple moving averages also accomplish this goal, often with more consistency. Experiment with what works best for you, and understand that you are often thinking too hard when you focus on fine details. Here's a long-term example with Climarex Energy Co. using simple, weighted, and exponential 200 moving averages. To enter these in Yahoo Finance, simply add a moving average and click on Simple to change the weighted or exponential. Then we see our chart and our graph and all three comparative moving averages. From highest to lowest final price, we see the 200 weighted moving average, the 200 simple moving average, and the 200 exponential moving average. You see there was a big downtrend at the end in that stock. Here, the weighted and exponential weekly moving averages closely follow the simple moving averages. For support and resistance levels alongside price average crosses, these averages function similar to simple moving averages. However, weighted and exponential moving averages are generally used less because of their increased complexity compared to simple moving averages. This is shown specifically in the graph of XEC in late 2011 to 2013, when the stock initially bottomed under the weighted and exponential 200 MAs and at the simple 200 MA. The stock later found resistance and broke away from its lows when it crossed back over the simple moving average. As more people use simple moving averages, the perceived significance of the calculated psychological price level increases. Nonetheless, all three of these moving averages help you to identify trends. Simply use 1 to 3 simple moving averages on your charts, and they will help you identify long-term and swing trades through lagged average prices. Stick with 50, 100, and 200 simple moving averages to find the best natural support lines, resistance levels, and moving average crossovers in stocks and more. Trend is your friend. And moving averages help you identify and profit from price average crossovers, moving average crossovers, and large potential moving average deviations. Yahoo Finance also allows you to add moving average envelope to your charts. By default, Yahoo Finance bases this envelope on the 50 moving average, but you can change this to any period. Yahoo also systematically sets the moving average envelope charts with a plus or minus 5% range. Even though you can change this percent value for the range, this envelope proves less predictive of support and resistance levels in practice. Rather, look at basic moving averages alongside Bollinger Bands to measure how far a price deviates from averages. We look at Bollinger Bands in Chapter 32. This indicator is better because it dynamically adjusts for price volatility rather than applying a static percent deviation to a moving average. As for 9 to noon trading, you will primarily use long-term moving averages to identify potential intraday support and resistance levels. Alongside VWAP, which we will discuss in Chapter 33, you can use shorter 20-period or 9-period moving averages to predict intraday support and resistance levels with short-term candlesticks. These short-term moving averages work especially well when identifying support and resistance levels in 1 or 5-minute candlesticks. Combine these moving averages with longer-term support and resistances from 200, 100, and 50 daily, weekly, and monthly levels to improve 9 to noon trading consistency. Moving on from moving averages, we discover the moving average convergence divergence (MACD) and moving average divergence deviation indicators. The moving average deviation simply tracks the standard deviation of a stock's price away from any given moving average. The most used and default moving average for MA deviation in Yahoo Finance is a 12-period average. You can use the MA deviation like the MACD to track volatility, trends, and potential reversals. Here's Apple Inc. with both MA deviation and the MACD. Then we see Apple on the top, there's the MA deviation, on the bottom there's a MACD, and the MACD of course has the MA deviation underneath its signal and slow lines. Apple moves up as the moving average deviation simultaneously rallies before eventually crashing back down when Apple pulls back. You can time these movements by looking for the MA deviation to cross over the positive-negative average midpoint to find a great buy and sell opportunity at optimum prices. As you increase your time period, these movements become more significant. Note that MA deviation is almost the exact same as the underlying bars in the MACD indicator. The moving average convergence divergence measures momentum oscillation through the MACD line, signal line, and MACD histogram. The MACD line is simply a stock's 12-period exponential moving average minus its 26-period EMA. This tracks weighted changes in the underlying stock's price. The signal line is a 9-period exponential moving average of the MACD line. Expect prices to reverse direction when the MACD line crosses the signal line like a death cross or golden cross, especially in longer time spans. The MACD histogram represents the difference between the MACD line and the signal line. Therefore, the underlying stock has high momentum when the MACD lines and histogram rise alongside the stock, and this momentum shifts as the MACD's lines and histogram reverse into negative convergence and divergence. Now that you know the technicals, let's look at the MACD on Six Flags Entertainment Corporation. Notice strong correlations to Six price and the MACD's lines and histogram. The MACD is positive when the MACD line is greater than the slower moving signal line and negative when the rapidly changing MACD line is below the MACD signal line. Look for selling opportunities in extended markets and buying opportunities in lower ones. You can see that there are strong buying opportunities in 6 when MACD crosses below 0 because there is a strong market demand and momentum behind the stock. You can use MACD to find and confirm temporary pullbacks to get the best order prices possible when you enter a position. Use the MACD line to spot reversals in the MACD, crossovers, peaks, troughs, and trends. Look out for green to red shifts, zero average crossings, peaks, troughs, support levels, and resistance levels in the MACD histogram. And then if we look at Six Flags, we see that when the signal line crosses over the slower moving line, or the MACD line crosses over the signal line, the crossover is shown in the price, and then it creates an uptrend all the way up until another crossover when there's a downtrend, and then when there's another crossover it goes up, and especially on some of these larger bell-shaped curves there's a crossover up, crossover down, and that crossover point on this MACD is where you would try to get out of that position or into that position as it goes up or down. MACD lines may rarely form short-term trends alongside price action. You could draw trend lines on some particularly strong MACD lines to predict and trade future breakouts while you simultaneously watch the two lines for a strong cross. The MACD is a solid indicator that you can use on almost any medium-term to long-term trading setup alongside 50, 100, and 200 moving averages. Keep these on your charts.